Hear me, if you could please come and take a seat if you would like to watch this presentation of mine. This is mostly for fun. I'm not here to shill a bag or anything like that, or even to promote a project. This is simply recreational public speaking, which I thought may be of value to ETH Denver. Just to get us started, my name is Boaz Shoshan. I'm from Scotland, and I do work in the Web3 space on the communication side, which is helping projects communicate clearly. However, for the sake of ETH Denver, I'm actually putting on my former hat, which was in investment research, and specifically to talk a little bit about how inflation will affect the crypto market. Because after speaking to quite a few of you, I found that a lot of you are quite wrong with what you expect may happen in the event of very high inflation, or indeed in just dealing with the existing inflation that we have already. So, just to get us started, we'd start here. This is simply the government-reported inflation rates across the developed world. I'm sure you're all very familiar with the fact that inflation is very high at the moment, or at least it's a lot higher than you have experienced it in your lives. I don't see many old people in the audience in ETH Denver, and frankly, crypto is a young man's game anyway, so I wouldn't expect that in the first place. Before I do get into much of this, I should say that while I did used to work in investment research, none of this presentation is intended as financial advice, so please don't take it as such. If you do disagree with any of my views, feel free to tell me afterwards, and we can go outside and have a fight or something. Funnily enough, I discovered today that you can actually still have a pistol duel in New Mexico. It's completely legal, and the police will not be able to intervene. So maybe if anyone from the foundations of the other blockchains are listening, perhaps we could host another conference there, and we could finally settle the maximalism debate once and for all. Just to get us into it, this is a very interesting metric which some dentists in the private dental system in the US like to track. Even kids are demanding higher wages for their teeth. Just imagine if you had held on to your teeth back in, whenever it was that your teeth fell out, and you had sold them today. It would have been a fantastic profit that you could have made, but you didn't, because you didn't know just the bull market in teeth was going to take place. Anyway, just to review on inflation in general. Why is inflation here in the very first place? So the portrait that we have here on the right is actually, I was in the Bahamas recently in order just to get into the US due to certain immigration complications. And I thought I'd drop by the Central Bank of the Bahamas, because the Central Bank of the Bahamas actually released a CBDC, a central bank digital currency, in 2020. Everyone likes to moan about how bad central bank digital currencies are without actually investigating the ones that exist already. The sand dollar is out in the wild, out in the open. You can do whatever you want with it, even though nobody in the Bahamas actually uses it. But inside the Central Bank of the Bahamas, there is an art gallery, and there is this portrait there. You can view the magnificence of this incredible work of art here of a man wearing his underwear over his head, and I think it pretty safely sums up what central bankers and the monetary viziers of our respective countries have done over the past few years. So the Central Bank of the Bahamas deciding it was a good idea to actually hang this in their central bank speaks volumes of just how self-aware they really are. Why is inflation here? Well, it turns out that all of the unexploded ordnance of the post-financial crisis era of the past 10 years is suddenly starting to catch light. So very low interest rates for a very low period of time, accumulated with lots of debt, and the desire for the government to spend more is actually starting to have some pretty severe repercussions in a lot of the world. Just in terms of why I think this is going to continue. So we've already got all of this high inflation in the developed world. Why will this keep going? You can see in some countries that inflation has started to taper off. Maybe we will just get back to the glory days of the 2010s, but I doubt it. Why is this? Well, central banks don't want to stop inflation. It's destroying the debt problem. Over the past 10 years, there's been an enormous amount of debt that's accumulated in the public and the private sector as a result of very low interest rates. Central bankers were keeping the rates very low in order to try and create inflation, but actually had the reverse problem. So you end up with lots and lots of debt because it was very, very cheap. And what happened instead was that the debt burden actually made it harder to create inflation in the first place. So central banks don't want to spoil the show now that it started. They waited forever for inflation to finally begin and finally start burning away the debt. They do not want to halt it right as it's arrived. You will have noticed, if you've been paying attention to some of the central banks over the past several years, that they started advocating for things like catch-up policies, where they let inflation run significantly above their target because inflation hasn't been running at their target for so long. So the idea is, when you finally let inflation arrive, you let it run really hot in order to make up for all of the inflation that you didn't create over the past several years. At the same time, governments don't want to rein in spending, as they'll get voted out. Thatcher and Reagan are not coming back, guys. It's just not going to happen. Nobody is interested in small government, low taxation, or at least nobody in the broader electorate, I'm afraid. So no point in voting for that even in the first place, because it's just not going to happen. Governments are going to keep on spending. They're going to find new ways of doing it. And Pandora's pandemic stimulus. So all of the new spending techniques that were discovered during the pandemic, they're not going away, and they're going to stay there for some time. You're going to see a lot of interesting ways where the government can incentivize spending or incentivize the printing press of the commercial banking system one way or another. I'm from the UK, I'm from Scotland, and we had what was called the Bounce Back Loan Scheme, the BBLS, whereby the government would guarantee private sector debt that had been created by the commercial banking system. So to give a little review, the overwhelming majority of money in the private sector is generated by banks, not by governments, and this is done through the creation of loans. One of the reasons why China has been so successful in growing its economy over the past 20 years is that they figured out, well, if you can just make banks make loans, you will create GDP growth. You will get economic growth. Maybe malinvested, however, there will be GDP growth in the first place. So in a classic example of capitalism with Chinese characteristics, we're now seeing a lot more of that in the UK and in the US and in developed nations, whereby the government is trying to get commercial banks to issue debt in order to spur economic growth. So with the bounce back loan system, the idea was, if you just get all the banks to make loans to businesses that are in need of loans, and you guarantee the debt. So what happened in the case of the UK, you had more than 600,000 loans that were issued by banks, and some senior bankers went on the record with the Financial Times and were happy to admit that 40 to 60% of those loans could easily be defaulted upon, and a quarter of them wouldn't even be issued in the very first place. So this pandemic stimulus response, or pandemic sort of insurance response, could easily be issued in the future when you consider that the government wants to make the world green, it wants to cure poverty, it wants to wage a war on whatever. And it's very easy in this case to just get commercial banks to write loans in this way by saying, well, just if the investment goes bad, fine, the government will pay for it in the few instances that the loan is not repaid. Of course, over here in the States, you had your stimulus checks. I doubt that'll be the last we see of stimmy checks. They were great for the last bull market, so if you are here at ETH Denver, you're probably not complaining. And at the same time, we of course have commodity price instability as a result of geopolitical instability. So in Germany, of course, they're heavily reliant on Russian gas, and the rest of the world is actually heavily reliant on Ukrainian and Russian exports in the agricultural sector, particularly fertilizers and grains. When the price of these things go up, well, the price of everything goes up. And when the price of everything goes up in America, the price of the dollar goes down. And when the price of the dollar goes down, the price of everything else in the rest of the world goes up. So I think inflation is going to be here with us for quite a long time. And we're all just going to have to deal with it. What does this mean? Well, just to give an example of how high inflation is and how we are in an era of financial repression, this is all of the debt that is currently in issuance from the United States government. This is the key piece of collateral inside the banking system, and all of it is yielding less. It is paying you less than the CPI inflation in the United States. So the recent CPI print came in, I think, at 6.4%. And all across the yield curve, every different type of bond, you are going to be receiving less than that. So your savers are effectively getting slowly euthanized, as we might say. Now, this image requires quite a bit of context. So we are talking about crypto in the first place, but the last time we had a really strong global inflationary shock was in the 1970s. 1970s, none of you guys, well, maybe a few of you were around to experience it. Very few people around here were investing during it. It's a very difficult time to be an investor, but there are plenty of lessons that we can actually learn from the 1970s when we are thinking of crypto today. So back in the 1970s, even though that was an awfully long time ago, there were plenty of tech stocks, or there were at least quite a few big ones. So in this example, we have Hewlett-Packard, we have Intel, and we have IBM. And we've got the yellow line there, which is just US inflation. This is over the entire decade of the 1970s. And you may look at the chart and say, well, at least the lines go up, sure. But this is a decade where by the end of it, you had 44% of your purchasing power, according to the government's own statistics. So this is a very politically sensitive figure, is the rate of inflation in your own country. Plenty of former officials from plenty of different developed countries have gone on the record and say, yeah, we massaged the figures because if the inflation was too high, then we would look bad and we wouldn't get elected again. So this is by the US government's own record. You lost 56% of your purchasing power over the course of a decade. And of course, it was actually a lot more than that because 1970s were a period where gold was completely unmoored from the financial system in the first place. So if memory serves, gold was $35 an ounce back in 1971 when Nixon decided it was time to get rid of it and allow for, the monetary system as we know it today. So at $35 an ounce, that works out to effectively $1 per 0.88 grams. By the end of the 1970s, that 0.88 grams was worth more than $13. So that was how much inflation you were getting during this period. Now, IBM, Hewlett-Packard, Intel are all fantastic companies. Or if you could see, you had a good vision of the future and what tech would do and how the world would change. All three of these companies did go on to change the world. They went on to conquer the world, and yet, during this period, you didn't really make much money off them. Instead, you actually would have made considerably more money if you just held a pet rock, or gold in this instance. So this is the same chart, but we're using gold. Adding gold to it makes all of the performance of these tech companies look considerably worse. So it's up by, I think, 1,300% during that decade. As it was a very grim decade for the average man, and when it's a very grim decade for the average man, the price of gold goes up an awful lot. So the main moral of the story is, even if you're right, and the project or the technology you're backing does end up changing the world, depending on the economic conditions you're investing in, that might not mean that you make a lot of money. I mean, thanks for the money. You are investing in the future. You are helping these companies go on to conquer the world. But if you're trying to make money, this might not actually be the best thing for you. So why is it? Why is it that the market does not like high inflation or raised inflation when it is looking at, why does it not like growth companies, tech stocks during periods of high inflation? Well, to put it simply, what happens is over the past 20 years when we've been investing in crypto, we've been in a period where in the developed world, crypto has existed when there's been low interest rates and low inflation. Now, when there's low interest rates, investors want to, they need yield somehow. And if they are not desperate for yield, they are willing to go way out in the risk curve and just give money to companies or write checks to companies which claim that they are going to conquer the world. And once they've conquered the world, they will go on and pay you a real return. So for this, just imagine the likes of Uber or the likes of plenty of the Web 2 apps which were not very profitable or which to this day remain cash flow negative, which have consumed enormous amounts of money. They've managed to get all of this money because there's low interest rates and there's low inflation. So investors are very happy to write you a big check because they're confident that the value of their money will be roughly the same in the future. In the event of a high inflation environment and investors are very unsure of the value of their money in the future, well, this all changes. It also changes because low interest rates stop being low, and this makes the market much more interesting. So at the moment, you can get 5% on US 5-year treasuries, I believe. So it's very easy to get 5% yield. If you add a bit of risk on top of that, you can then enhance that, and it becomes much more attractive than simply, effectively writing a check for a VC fund when interest rates are 0 or negative. So just to summarize. So previous crypto cycles have taken place in a low interest, low inflation environment, and crypto is actually just one of the numerous asset markets that have boomed during this period. So we're all very aware of crypto because we're in it, but actually if you look around to some of the alternative yield investments, there have been quite an extraordinary boom in them. So you found pension funds that are giving bridge loans to fast food franchises. You've got very large traditional investors that have been getting into commercial airline leasing. And my personal favorite, buying music royalties from pop stars who are getting very old. You'll notice that is, in fact, still happening now. So you find these very traditional conservative investors have been forced into these much more risky, much more speculative asset classes as a product of there being low interest rates and low inflation. And crypto is just one of these. So we're not really aware of it because we're in crypto, but all around the world there's been an incredible reach for yield. So the bad news is that at the moment, crypto just trades like a tech stock on steroids. So tech stocks have been the ones who've benefited from the low interest rate, low inflation environment, this growth environment. And sadly, Bitcoin and Ethereum both trade like that. So if this correlation continues in the future, Bitcoin and Ethereum are actually going to have a pretty bad time, and the next cycle is going to look a lot different, in my view. To be clear, I've not just overlaid one line over the other. The Bitcoin chart here has been put on a logarithmic scale in order to make sense of some of its volatility. But when you do that, and you strip away the volatility, which is a product of low liquidity, actually it's pretty hard to deny that Bitcoin just trades like the NASDAQ on steroids. Ethereum is a similar story. Though hopefully we are seeing at the very end of these charts some kind of unmooring. Maybe not with Bitcoin, but maybe a bit with Ethereum. So, some key takeaways from this, from my point of view at least, is that if we are going to see another great cycle, Bitcoin and Ethereum need to decouple from tech stocks. Because when you think about it, they're not really tech stocks in the first place. We are always telling people that they're not securities. Why can't that actually be true? In order for a new cycle, I think there will be, this is just my personal view, but I do believe that there will be a decoupling that will be a product of a market crash in tech. So when tech stocks get really wrecked, I can easily imagine something like Bitcoin or Ethereum to do pretty well out of it. And the reason for that, in Bitcoin's case at least, is a result of its scarcity. So maybe in the future we will see Bitcoin start to trade like digital gold. Maybe we will see Ethereum start to trade like digital oil or something similar. But they are certainly not doing that now. And that's the main point I want to get across to everybody. Lots of people say, oh man, the government is inflating the money away at this crazy rate. And then they'll show you a chart of what Bitcoin costs in Zimbabwe or in Venezuela. And yes, in these countries where there is hyperinflation, there is a perpetual bull market for crypto assets. But what we're talking about here is just higher inflation in developed economies rather than hyperinflation. And the market for Bitcoin and Ethereum, other crypto assets, is made in these markets, and it's not made as a product of it being an inflation hedge. It is made as a product of it being a tech stock on steroids. So in order for this to change, we need to see market behavior to change, and that's not happened yet. Hopefully it will happen in the future. When it comes to the broader crypto market, I think the growth in infrastructure may not lead to higher token prices as it has previously. So imagine, we all keep building, all the developers in Denver keep building. There's all this incredible growth of the ecosystem, loads of very talented software developers, and token prices do absolutely nothing. They stagnate. People don't expect that, but that actually could happen because the market simply does not favor this. So when we're looking at the price of IBM in the 70s, it's not like they were just sitting on their hands, right? There was plenty of development going on. They were actually going on to conquer the world, but the market was not interested. So this is something that we need to be prepared for. If you're a speculator, you may actually be very disappointed if crypto does not decouple from tech stocks. Wild VC funding, harder to come by. So when FTX was getting, $420.69 million checks, just ridiculous stuff using meme numbers. This is not going to take place again in the future as the appetite for this dries up, and wild tokenomics are much less likely to be successful. We need much more mature token utilities in order for tokens to actually hold their own in this kind of market. So having trillions of tokens in a high inflation environment is just not going to work. It's not an appealing proposition. And saying, well, we're just doing a token and it's going to be a governance token, but in terms of the actual governance structure we thought up, we're working on it. We've not really got anything yet, but you will at some point in the future be able to vote on something in a DAO while the core members of the team maintain most of the voting power. This is just not a very sexy proposition in this kind of environment. So in order for the tokens to really hold their own in the market, they do actually need some kind of mature token utility. Tokenization of yield-bearing instruments is something which is started to happen. You have seen, I think, backed in Switzerland, where they've started tokenizing US treasuries so that owners of the stablecoin can actually start owning some of the yield as a product of the US government. I think that's going to grow a lot as a product of a high inflation environment. we're in the crypto space, there's plenty of room for growth here, but at the same time, there is still an enormous demand for yield. And one thing which the crypto market has been actually very poor at doing is developing a credit market. When you consider that the traditional financial system is built on credit, this is the core pillar of the traditional financial system, the banking system. It's quite extraordinary how we don't really have many versions of credit inside crypto. And this is a very difficult problem, of course. When there's not a security, when you're not relying on actual government to uphold the law when it comes to creditors and debtors, I can understand why it's very hard to do this. But development of a credit market which can adjust for inflation is something that will need to be developed in crypto and will, in a lot of ways, help out in an inflationary period. Because during bear markets, TradFi investors turn to credit. Why should that not happen in the crypto market? Though in fairness, in a high inflation environment, credit can get wrecked as well. But I think that has covered most of the points that I would like to show today. Lastly, this is just a for fun presentation on market commentary. If you are interested in listening to more of my musings, we do have a podcast where we drink beer and give credit ratings to breweries. But my name is Boaz Shoshan. That's all for today. Thank you all very much for listening.